Good afternoon, ladies and gentlemen. I have the pleasure to welcome you to our Luxembourg Investment Outlook 2021 webinar, A Brave New World. So my name is Patrick Artus. I'm your host during this webinar. I'm the CEO of UEP Luxembourg, and I have the great pleasure to present you four great professionals that will animate and speak about their outlook in 2021. So the first one is Norman Fineman, who's the CEO of the wealth management side, and who's speaking about the investment outlook 2021. Nicolas Laroche, who is global head of investment advisory, will talk about selected teams in 2021. Pierre Corby, our healthcare specialist and very actual subject, will speak about the healthcare sector in a pandemic world. And to close, Gaetan Aversano, who's head of PMG EMA, who will talk about how to generate income in low-yielding environment. So before starting the presentations, may I remind you that you can submit your questions by typing just under the streaming screen. Type in the questions and we will treat them during the Q&A session just afterwards. But now I have the great pleasure to hand over the word to Norman, who will give his views on next year's outlook from UEP. Thank you.
Thank you, Patrick, and thank you, everybody, for joining us. For those of you who have joined a UBP Outlook in the past, you'll know one of the things we like to do to make sure we're aware of when we get things right, and most importantly, when we get things wrong. We like to review what we've said at our last Outlook. And in June of this year, it was, if I'm honest with you, a particularly challenging one. We had just come out of the lockdowns. There was quite a lot of uncertainty. But as we look back, we actually had a reasonable perspective on what has actually transpired. In particular, our focus in the equity markets on quality and growth type of strategies has worked out very nicely. Within fixed income, our pivot away from interest rates and focus on spread and spread compression, looking through the interest rate volatility, was a key message that has worked out very well. And the idea that the US dollar weakness that had begun in March was going to continue played through very well. But most importantly, something that has served us very well in 2020 overall has been our active risk management strategies, which was very helpful for what has been really two-way market throughout the summer and into the fall. So as we look into 2021, where we always want to begin is with the global economy. And if we look at slide 6, one of the key questions we've been getting from a lot of people, especially as lockdowns take hold again here in Europe, as well as in the United States, is there the risk of a relapse going into 2021? And when we look at things, we do think this lockdown is substantially different than what we've seen in the March period in particular. Really, first of all, you can see the trajectory on this first slide is much less steep. And so you're not seeing the amounts of layoffs, you're not seeing the defaults moving through the economy. And it's really what we've been noticing is just a slowing of the economy that otherwise had reasonably positive momentum coming through the summer. The second piece of the puzzle really is that policymakers, learning from March, have been very responsive, especially here in Europe, to reinstitute the support for the economy to allow them to get through this lockdown period. But I think the two things that are most important in terms of why we think this is different really have happened in the last few weeks. And that is the developments we've seen on the vaccine front. And you can see on this right-hand panel, even though the economies have rebounded over the summer, what has not rebounded has been consumer confidence. So consumers still remain rather cautious. Pierre will talk a little bit more about the medical aspects of the vaccine, but we expect as we move into 2021, as these vaccines get deployed, the consumer will come through much more forcefully, and that will provide a boost to the economy that we really haven't seen year to date. On the following slide, we'll see another important difference between now and March, and that is what's happening in China. You'll recall the pandemic itself had its origins in China. In February, China was in outright recession, providing a drag to, especially here in Europe, important export-oriented economies. Where we sit today in China is somewhere very different. Instead of a recession, not only have they moved through the recovery phase, but now they're in outright expansion with manufacturers and consumers contributing to growth. So from that perspective, yes, we think there's some near-term risk to the economy, but we think we transition away from that through the winter here, and we'll see more meaningful expansion as we move into 2021. Now, on the monetary policy side, something that a lot of people have asked us is, does this mean the Federal Reserve, the ECB, will pull back their support? And we think the answer to that is no. In particular, when we look at permanent unemployment in the US here, or even in Europe, those numbers still remain unacceptably high. And indeed, the central banks are targeting this employment figure. And so from that perspective, we think there is little likelihood that you'll see anything but accommodative policy on the part of central banks, even as unemployment falls and even if inflation starts to rise going forward. So as we speak to people about this backdrop, they'll say, okay, we can see things are improving. But on slide 8, you can see the concern they really have isn't that already in the markets? Valuations are very high. The market is already pricing that. This looks a bit like 2000. And indeed, from a valuation perspective, it looks a lot like 2000. Valuations that are a similar place to that bubble period at the turn of the century. But we think the valuation picture only tells half the story. The other half of the story in 2000 was a story of earnings that were going into a cyclical peak and eventually into outright decline in 2001 and 2002. If we look at earnings in 2020 will end up contracting something on the order of 25 or 30%. But as we move into 2021, those earnings are inflecting and starting to reaccelerate. So again, next year, investors should be looking for 20 to 30% earnings growth, with a bit more boost if we do get the vaccine deployed on a consistent basis and earlier than expected. So that valuation story is a concern, but where we want you to focus is really on the earnings story. And there are two real drivers that we want to focus on from an earnings perspective. As we can see on slide 9, the first one is a cyclical driver. And this is a story that has plagued a lot of people for the past year. These old economy, value-oriented stocks have really lagged more growth-oriented new economy stocks. And everyone's saying, there's this disconnect between the markets and the economies. In fact, there hasn't been, because you can see these growth-oriented names, they've been able to sustain sales, sustain margins, and really grow earnings, where these more old economy value names were contracting in terms of sale growth. They were losing momentum because the economy was shrinking. What we see going into 2021 is the manufacturing sector has inflected, and historically that will trigger a turn in the sales number that has weighed on earnings. So investors should start looking for opportunities for cyclical recovery, selective, especially with a quality bias, to drive returns in 2021. If we look on slide 10, the other side of the coin is this longer cycle transformation story that we think remains in play in 2021. Again, we're of the view that the pandemic has triggered probably one of the most important accelerations in technology and transformation within the global economy. And so a lot of the themes that have been focused on in 2020, things like technology, moving online, healthcare, biotech, they will remain intact. And indeed, Pierre is going to spend some time talking about some of those themes in healthcare in particular. But we think these themes expand further to include stories like climate change, digitization of the financial system, fintech, as well as the growth of domestic China. And one of the key messages we want to leave you with these transformative secular types of stories, if you look, whether this is the long-term growth in biotech for the last 20 or 30 years, this move online in terms of retailing, or even the more nascent move to green energy, these do tend to be very profitable long-term trades that come along with volatility. And so this is where active risk management, active analysis is going to be very key to help navigate that over the course of these long cycles. When we look to the fixed income side on slide 11, what a lot of clients have asked us is, look, dollar yields, euro yields, Swiss franc yields, everything is near zero right now. How do I generate income in this kind of environment? And the answer, we think, is really multifold. For people who want to try and stay in the traditional bond realm, you're going to have to accept lower returns. But even in lower coupon, high quality bonds, Europe really sets the stage in terms of what we're looking for in US dollar yields, meaning these yields should move to negative on an inflation adjusted basis, just like they have in Europe. And so to help enhance return, you're going to have to move farther afield, geographically to places like China, emerging markets, to places like the cocoa market in Europe, which we think is very attractive, or alternatively, private debt and alternative approaches like long-short credit are going to be ways that are instrumental in enhancing yields in a no-yield or low-yield world that we see going forward. One part of that will end up being using currencies a bit more actively. And so if we look on slide 12, that's actually going to be well supported by what we expect to be a bear market that continues in the US dollar. As you can see, coming out of recessions, typically the dollar is very weak. And so we're at the early stages of that. We think euro dollar can move into the mid 120s as we move through 2021. But to give you a sense of, if you like, how mispriced the dollar is currently, we look at the Chinese renminbi, where because of the trade war, the renminbi became very undervalued against the dollar. And so even though the renminbi has strengthened very meaningfully against the dollar over the course of the last few months, we think that interest rate differential, it's yielding over 3%, positive inflation-adjusted yield in a currency we expect to appreciate against the dollar as well as the euro. This is a place where we think a lot of investors should begin allocating some capital to capture both yield as well as currency gain going forward. This move on the dollar on slide 13 is also going to translate into a reflationary environment that should be good for both precious and industrial metals. The gold story was a very good story coming out of the March lows, rallied into about 2,000 going into August, but since then has trended lower. And that's largely because we haven't seen yet this acceleration in inflation. That's going to be this next leg of the rally for gold here, and we expect that to come in 2021. And then as we move into the industrial metals, we think this is a story that has legs next year as well, not only as the industrial cycle turns, but as increased green spending moves through, the supply-demand imbalances in places like silver or palladium look to drive prices meaningfully higher from here. If we look to slide 14, one of the key questions a lot of people ask us is, that sounds very optimistic, what do we worry about? Really, two things we worry about and are on our radar. The first one is, even though the US-China trade war ended in a truce at the end of 2019, we think those tensions, now that Joe Biden is in office, have the potential to continue to expand and become multilateral, really drawing in potentially Europe as well as maybe Australia as well. So we'll want to keep an eye on that going forward. And then as well on the inflation front, if inflation comes sooner than we expect, that will be something for central banks to deal with. But as you can see here, the recovery of inflation really is very much in line with what we've seen in previous cycles. And so we're not too concerned that interest rates or central banks will need to become active on the inflation front going forward. So just to wrap up, On slide 15, a few key messages. Again, we do think even though you're seeing lockdowns in Europe, focus on the recovery of global growth going into 2021. That's going to be driven by fiscal policy that should bring inflation rising through the year. That's going to leave us focusing on earnings growth in the equity space. That's where we think we're going to drive most of our return here. And we really want to be barbelled between these transformational growth opportunities as well as quality cyclical positions that should benefit from the recovery in the economy. If you're an income-oriented investor, a bond investor, you want to look through the interest rate volatility that you'll undoubtedly see and really focus on carry. You're going to have to create a wide portfolio to capitalize on that reaches into places like emerging markets in China, as well as long-short credit and more private market strategies to generate the kinds of yields investors are used to. And then lastly, to enhance that, we think investors would have the opportunity to capitalize on this dollar bear market going forward to try and enhance yields as well. So I'm going to stop there, and I'm going to hand it over to Nicola, who's going to spend time on some of these transformational themes that we see for 2021. Nicola, I think you're on mute.
Okay, so thank you very much, Norman, and good afternoon, everyone. So let's start the presentation on slide 16, maybe with the conclusion and the key messages, as you just highlighted. What we need to keep in mind for next year is that we will be in a cyclical recovery environment. At the moment, we expect more than 5% GDP growth next year, 5%. This number is a bit the consensus of all macro departments, and there is, I would say, high probability that this might be revised to the upward. The reason for that, obviously, is the vaccine news flow that has been extremely important the past 2 weeks, which we believe definitely is a game changer, because the global population will have the tools. Will have no excuse actually to get vaccinated, as the quality of the vaccine looks extremely good on the efficacy as well as on the safety side. So the big message on the macro is that next year things will recover with potential positive surprise. So looking at the strategy, it has a strong implication when we look at the asset class. As Norman just mentioned, we will continue to live in a low yielding environment. The Fed already said that they will keep interest rates close to zero until 2023, and the long-term yields, even in a cyclical recovery, if they can pick up a little bit, we don't expect a large upside for this, on it, which means that the fixed income investors will continue to shift away from fixed income. And risky assets are likely to benefit the most again next year. It's what we have seen this year. It's likely to be repeated next year. If we just take a couple of numbers, the fixed income market globally, it's 128 trillion assets. So it's a huge market. It's bigger than the global equity market, which is at 94 trillion. And there is a shift reallocation, as the central banks obviously are buying bonds, are buying fixed income to keep interest rates low, and they are shifting institutional as well as retail investors into more risky assets, and equity is likely to be the best beneficiary. The third point, obviously, is everyone is asking the question: what do we need to choose between all the COVID beneficiaries, the growth stocks, the technology, the Nasdaq? Do we need to stay invested in this type of style, or shall we switch to more cyclical? The message we really want to give is that we can do both. We don't necessarily need to choose one versus the other. We will see in the presentation that we can build a portfolio, an equity allocation with a barbell strategy, having some growth-oriented names and themes, as well as having a bit more risky exposure in recovery sectors post-vaccine news flow. Also, Well, in terms of risk, it's obviously rising inflation next year will be the thing to watch. But central banks will certainly not repeat the mistakes made at the end of 2018 when they were starting to raise interest rates too early, and it pushed equity sharply lower. So, as Norman said, it's a risk that that is maybe not for next year, maybe for 2022, and also obviously we'll start talking about European politics with the German elections and the French election coming 6 months after in mid 2022, but that's more end of next year topic. So shifting to the next to the next slide, when we look at the asset class during the presentation, we will mostly discuss equities, but on the advisory side, before jumping to equities, on fixed income, it will remain broadly unattractive because yields will stay low, spreads will stay low as well, and as you know, central banks are buying a lot of bonds in developed markets, so it's difficult to see any value in developed markets, which means that on the contrary, emerging markets inside the fixed income space remains okay. That's where we would shift portfolios, and that's where we would definitely have the biggest conviction. Asia in particular, because when we say that 5% GDP recovery next year globally, it will be led by China. China will grow more than 8%, certainly in 2021. So the macro backdrop will be quite strong. And in terms of credit, it's where we can see still a bit of value as spreads in China are still above the long-term average, which is not the case for Europe or for the US. So we would definitely build China and Asia bond allocation. Otherwise, being extremely selective will remain important in fixed income in a global scenario, global recovery scenario. Some part of the high yields benefiting from the recovery, like the travel and leisure, like the cyclical story in equity, we can see on a selective basis there will be some opportunities on fixed income, and also to find a bit of yield of carry, COCOs, and especially in Europe remains quite good. So if we summarize, at the moment we can have a BB plus bond portfolio with a short duration of 4 years, 50% emerging markets, 50% developed markets, with this type of theme, and we still can get a 4% yield in dollar, which is, I would say, acceptable, but that will remain, as a conclusion, a difficult market. Commodities, we like gold. Risky assets will do fine. It's a protection. The recent pullback definitely offers some entry points, so that's I will not come back on these points. And alternative investments will deserve definitely a bigger allocation in portfolios. So we have the pleasure to have Gaëtan with us this afternoon discussing the asset class. I would also take the opportunity to add that structured product at UBP, it can really offer a good alternative to switch some bond exposure into equity. We like some type of structure where we have the possibility to buy quality stocks at a large discount versus the current level. And for this, you can be paid, you can receive attractive coupon between 8 to 10%, with the risk of buying good quality stocks at a deep discount. So to shift portfolios from fixed income to equities, we think it's still a very good tool to have in portfolios. Moving to the next slide. So shifting to equities into more in particular, why we think that equities will remain the best asset class next year. Certainly, it's definitely good. As Norman said, the story will be on earnings growth. At the moment, the consensus on earnings is around 22-25% for 2021. There is a high probability that this consensus will be revised to the upside, just because the vaccine news flow has not been really incorporated. This 20% earnings growth was already visible a couple of months ago. It has not yet been adjusted post-vaccine. If the recovery is faster than expected, if the lockdown are I would say if the economies are reopening faster than expected, the sentiment improves, we can have a good surprise actually in earnings. So when we look at the chart on the valuation of the S&P for next year, divided by the growth that we expect for next year, we can see that it's obviously valuations are a concern, but we are not totally out of the range. We can see that for next year, we are at a peg around 1. The lowest the bar, the best it is, the cheapest it is. We see that in 2007, 2008, no, it was, 2009, it was quite cheap, as the market was obviously cheaper, and there was a recovery coming post the global financial crisis. So peg around 1 is lower than the 27-year average that we have on this chart. The long-term average is around 1.4, 1.5, meaning that, yes, the market is expensive, but as long as we have growth in earnings, it's a risk that we're ready to take. Obviously, the big questions will be what's in terms of style on the equity bucket. Growth has outperformed massively this year. We see on the chart that since the bubble of 2000, growth has never outperformed as much as today, as this year. So obviously, this is a concern. It's explained by obviously the digitalization post-COVID, which has accelerated. It has not it's not nothing new. It's just that it has accelerated the investment in the space. We will see in the presentation that it's actually this will not reverse. We just want to lower the expectations on growth-oriented stocks. We will not have such a valuation gap to continue certainly in 2021. There are strong arguments that it will shift. Also, the market will broadly move higher, but on a more, I would say, broad area with cyclicals, value, and growth able to grow. But so that's why this barbell strategy of having a bit of both makes sense. Moving to the next slide. That's how we would allocate equity, the allocation on an equity portfolio on an advisory basis. We played a game on say what type of equity portfolio we would have for 2021. We would still keep the high growth area, and we will see that we are not expecting any slowdown in the cloud, in the healthcare, in the biotech, in the digitalization of healthcare, in the new consumer. Obviously, growth has accelerated this year, but it's likely that the growth will stay elevated in 2021 as the penetration of the addressable market remains quite low, and it's not really depending on the economy. We see that on this sector, whatever the global GDP is doing, if it's -5 or +5, these companies are able to grow. The best example is this year, where, for example, if we take the SaaS revenues have increased 30 to 40%, while the global GDP was -3.3%. So that's kind of outstanding. So we do not want to reduce allocation to this. So that's a long-term thematic. We definitely like the cloud. We like the healthcare IT, the new consumer. So it's just an example of couple of convictions that we have on this space. I will not go into the detail, obviously, of the stocks. We think that large cap techs remain interesting. There are risks on the regulatory front, but it has been a bit lowered post-US election as with a divided Congress. Most likely, this high risk of regulation is a bit lower. It's still present, but a bit lower. These companies continue to grow, and so we continue to like these names for 2021 and certainly for beyond. On the opposite side, we think that cyclicals is definitely a deserved place in the portfolios. We would prefer quality cyclical on this because that's well-managed company, free cash flow machines, sometimes leaders in their field that will benefit from the recovery. And that we have a couple of examples of these blue chips that we like in this space as well. And then the last segment is certainly the most aggressive, the most cyclical area in the market. It's where it is clearly companies that have been dramatically impacted by the lockdowns this year. But that's more tactical play that we are playing at the moment. We will not necessarily still hold these names in the middle of next year. It will depend of on the strength of the recovery on these sectors, but obviously the travel and leisure sectors, the restaurants, the hotels, we are not really touching the airlines except few exceptions. But these type of stocks at the moment offer some value. It's more tactical. It's not a long-term theme, but it's that's the way we would allocate equities at the moment. Before letting Pierre discuss on healthcare, I wanted just quickly to highlight two themes at the most extreme. So on the next slide, if we look at just the world on cloud, we receive a lot of questions. Is it the timing to sell, to take profits on artificial intelligence, on all the SaaS companies, because they have outperformed so much this year, so it will be difficult for next year to repeat. What we can see on the chart is the average revenue growth of this space, the SaaS, so software, cloud software, basically. Every year, since many years, the consensus is expecting between 20-25%, and that's what we see for next year. Every year, this consensus is beaten. Analysts are too conservative where they are forecasting the growth in this field, and so we can see that it has been above estimates the past 4 years. This year, in a big pandemic where the economy is slowing down, companies had to reduce costs. Actually, the revenue growth was higher than in 2019. So just to keep in mind a couple of numbers, the IT spendings globally, it's almost $4 trillion according to Gartner. $4 trillion. Today, the investments in the cloud space it's around, the number at the end of 2019 were around $100 billion. So it's still a fraction of all the IT spending that we can observe, which is extremely reassuring because whatever the economy is doing, most of companies will continue to shift to the cloud for obvious reason. It's decreasing costs for a company. It's saving times. It's reducing IT costs. It's much more scalable, especially on the work from home basis. There is much more flexibility. So there are a lot of arguments for companies to shift, even for medium-sized companies that we are not necessarily talking about, but do not have the means to have an IT department, and delegating all the IT to the cloud makes a lot of sense for them. So it's not only for the large top 500 companies. It's really a global I would say benefit. So just to keep in mind that next year, even in a post-pandemic world, there will be no slowdown in revenues. The recent quarters, we have not observed any slowdown in revenues, which means that these long-term themes remains definitely a co-holding in portfolio. And on the opposite side of the equity market, on the next slide, if we look at the travel and leisure sector, so it's totally different. It's more tactical. It's more short-term, but we think that the quality of the vaccine is so strong that we can expect actually a recovery in this. We can see on the chart that the occupancy rate in the US on the hotel has been cut by half. So the base effect in 2020 will be quite low. Obviously, the recovery will be lumpy. It will not be a one-way recovery. But that's the only space on the equity market where we can, for value investors, where we can find actually valuation below their long-term averages. Obviously, the cloud, many sectors, it's the valuation argument is difficult to hold. It's not cheap, but there is growth in front of that. On this sector of the market, price to book, price to sales, on a recovery basis, this sector remains quite cheap. And with there are plenty of arguments if the economy is recovering more than 5% next year, and with the quality of the vaccine, definitely there is more upside. Despite the 20% recent move, we think that in the next 6 months there is still 30 to 40% to be done on this space. So I do not want to go too much into the details. I think I took a bit too much time, so I will now hand over to Pierre. I think on a fascinating topic on healthcare.
So thank you, Nicolas, and good morning, good afternoon, everyone. I just remind you that you can ask questions by typing on the box on the screen, and we can answer these questions after the presentation. So we will now focus for a few minutes on the healthcare sector and the current pandemic. So in my presentation, there will be less numbers, less financial ratios. The goal is really to understand what the healthcare sector has been doing to fight the pandemic in 2020. Where do we stand now with a focus on COVID-19 vaccines? And most notably, what to expect for 2021. That's important, as the solution to this pandemic will come from the healthcare sector, and it will have implications for all the other sectors and the worldwide economies. So let's start with an update on the year 2020. So 2020 has been a very unique year due to the pandemic, which has disrupted our life and global economies. From a healthcare standpoint, 2020 has seen plenty of companies rushing to develop a potential solution to this pandemic in the form of treatments or vaccines. So first, on the treatment side, as of today, there are several therapeutic options available, but unfortunately, there's no magic bullet, and we can still die from the virus. On the positive, we recently had the pleasure to find out that 3 vaccines have proven to be efficient and safe. And as you should know, vaccines are really the key to get rid of this pandemic. So what to expect by year end? So we expect this positive news flow around the vaccines to continue, with 2 vaccines potentially approved in December in the US and in Europe. This is the vaccines from BioNTech, Pfizer, and the one from Moderna. And vaccination campaigns, they should start by the end of December in Europe and in the US. And they will start with at-risk people, so the elderly and the medical staff. On the following slide, we will have a closer look at the COVID-19 vaccines and their planned distribution. So first, the healthcare industry has done an impressive research work over 2020. Few players were able to provide an efficient vaccine in less than 10 months. It's really a huge milestone when you know it usually takes 8 years to develop a vaccine. I would add that this is a historical milestone as well for the biotech industry, as the 2 first vaccines to report a strong efficacy and safety data were engineered in biotech companies, namely Moderna and BioNTech. And they beat the big pharma players which are specialized in vaccines, notably thanks to their breakthrough technology. On the right-hand side of the slide, you can see key numbers pertaining to the vaccine space. I will just highlight the last 3 blocks. So Moderna and BioNTech, so 2 US biotech companies, they reported 95% efficacy for their vaccine. That's an impressive result, notably if you compare it to the FDA threshold of 50%. And if you compare it to the flu vaccines, usually they show an efficacy between 40 to 60%. So that's a huge result. Then, if everything goes well, the US population could be vaccinated by April 2021. And if we take into account the production capacity of the 6 leading vaccine developers, we reach 8 to 9 billion doses by the end of 2021. Please note that most of the vaccines, they require 2 doses per patient, meaning that by the end of 2021, we could theoretically vaccinate 4 to 5 billion people. Turning to next slide. So what to expect for next year? I think that's the most important topic. So we will still be living with the virus next year, and we anticipate that 2021 could be split in two. So the first semester, the virus will still be around, as vaccination campaign will take some time, and there is a need for several vaccines to be approved. For the second semester, US and European population could be vaccinated, but one has to keep in mind there are questions which remain unanswered around this new virus, like how long does the immunity last? Will the virus become endemic, meaning coming back every year? Or do vaccines prevent from transmitting the disease? As a consequence, it's a bit too early to predict how we could live in the second part of 2021 and beyond. Maybe there will still be some restrictions or constraints in place. On the right-hand part of the slide, you can see the number of vaccine doses available per company by end 2021. So we do expect vaccines from Moderna and BioNTech Pfizer to be approved by year-end. And in total, these two vaccines could be administered to 1 billion people by the end of 2021. Turning to the last slide of my presentation, I just want to illustrate how to navigate the healthcare sector in 2021. So first things to say is that fundamentals are strong, notably thanks to fierce innovation happening within the space, and more notably in the biotech subsector. So linked to the evolution of the pandemic, we have a positive view on the healthcare IT subsector, so meaning telemedicine, and the biotech subsector over the first semester. And then in the second semester, we expect medical devices companies to recover. They were penalized by the pandemic due to the postponement of elective surgical procedure. So to conclude, our two preferred subsectors for 2021 and after are the biotech and the healthcare IT subsectors, thanks to their fierce innovation, which translate into a strong revenue growth. So I am now done with my presentation. I will hand over to Gaetan Aversano, and I thank you all for your attention.
Thank you very much, Pierre. Good afternoon, everyone. I also take this opportunity to remind you that if there were any questions on any of the previous section, please, you can submit them via the box below the live streaming screen. On my end, for this final part of the presentation, I will now be talking about why private markets make sense and how this can help generate income in a low yield environment. So let us maybe start by looking at what private markets are and at the benefits that they can bring when compared to liquid alternatives. So private markets, simply speaking, refer to assets that are not traded on a public exchange and therefore characterized by some level of illiquidity. The four segments that you have in private markets include, number one, infrastructure. So this is, for instance, the acquisition of renewable energy assets like wind farming. Private equity, which means taking direct participation into a privately held company. Private debt, so for instance, providing a loan to a fast-growing small and mid-cap company that cannot access traditional bank lending. And real estate, for instance, the acquisition of a corporate headquarters. So on the right-hand side, you see that the major benefits of private markets when benchmarked against liquid assets are really that they can help achieve, number one, superior returns, which is driven by the illiquidity premium, lower volatility due to the long-term nature of the asset class, higher resilience during downturns, and also a lower correlation to other asset classes. On the other hand, the price to pay, to say so, is the relative illiquidity of these investments that usually spans over 3 to 10 years of investment horizon. Moving on to slide 30, and benchmarking private markets against public markets, you can see that there is really outperformance to be had with private markets, no matter at which asset class you look at. On slide 31, you will see on the left-hand side that private equity has actually been more resilient than the S&P 500 in the two major downturns that we encountered over the period 2000 to 2019. So really, in times of crisis, the performance of the S&P 500, for instance, was significantly below what was observed in the private equity sector. And on the right-hand side of the slide, you will notice that private equity did actually not only display higher resilience, but also exhibited superior returns over multiple timeframes when benchmarked against publicly traded stocks. Moving on to slide 30 and looking now at the benefits of private equity in a portfolio context, you will see on this slide the performance and the volatility of two portfolios. The first portfolio in green is a portfolio that includes 20% allocation to private equity on top of bond and stock allocation. The portfolio in green includes only stock and bond. And what you can see, interestingly, is that the portfolio, which includes private equity, generated both a higher performance while at the same time reducing the overall volatility of the portfolio. So in our view, there is definitely value in considering private equity and private markets in general as part of a well-diversified portfolio. So now, in light of these various benefits that I just described, we believe that indeed private markets should be systematically considered as part of a well-diversified portfolio for a sophisticated investor that has long-term investment horizon because of the illiquid nature of private markets and also adequate risk tolerance. So if we move on to slide 33 and discuss now how we at UBP approach private markets. So first of all, I'd say that we really run a fully fledged private markets platform that covers the four asset classes of real estate, private equity, private debt, and infrastructure. Each of these asset class, we approach it either via direct investments, via in-house managed programs, or via the selection of under-the-radar funds with a niche strategy. As you can see on the right-hand side of the slide, our focus is predominantly really on income strategies. So if we move on to slide 34, and to illustrate and give a bit of flavor on some of the transactions that we have done in the past, you would see on the left-hand side, for instance, in the income generation bucket, we have acquired several real estate assets leased to government entities or that serve as corporate headquarters. Within infrastructure, we acquired a highway with long-term concession contracts in place. We've done sale and leaseback of commercial aircrafts with top airlines like Emirates. We've acquired grocery stores, for instance, in Germany that also provide good income. Maybe now I'll take the last few minutes that we have to illustrate more concretely with two strategies and deals that we have done in the past, how private markets can really help generate superior income compared to liquid alternatives. So if we move on to slide 35, the first thematic that I will talk about is government-leased real estate. So UBP has launched several programs in the thematic and recently concluded an exclusive partnership with the number one player in this area in the US. So the objective of the strategy is relatively simple. It's to generate stable and predictable income, typically in the range of 7 to 8% per annum in US dollars, by acquiring real estate assets that are leased to mission-critical agencies of the US government, like the FBI, Department of Homeland Security, and so on. And this strategy is not only interesting because of the yield that you can extract, but also because of some inherent features of the asset class. Like, for instance, government properties tend to be 100% occupied with long-term lease contracts in place, so 7 to 15 years, which provides a lot of visibility and predictability on your future cash flow streams. You have a stickiness of the tenants, with the US government agencies usually staying 20 to 50 years in the same property, and a renewal rate that is usually in the range of 90 to 95%, so much above what you see in the private sector, and you have, of course, the best possible credit quality that you may look for with the US government backing by its full face and credit the lease payments. So what you end up with is really an asset class that has all the characteristics to ensure stability and predictability on your future income streams. And on the right-hand side of the slide, you really see how this translates when compared to liquid alternatives. So you see really that this offers the prospect for significantly higher income stream. Of course, this is suitable for investors that, again, is happy to be invested over an investment horizon of typically 5 to 10 years. Now, the second thematic that I would like to discuss is data centers, moving on to slide 36. So a data center is a terminology that we hear a lot nowadays. Concretely, it's a special purpose real estate asset that provides space, power, and cooling for IT infrastructure. So any company today that relies on data because of the technologies that its business is using needs space and infrastructure to install its servers and to store and process all the underlying data. So the business case for data center is relatively straightforward. The recent years have seen an explosive growth in the demand and consumption of data, which was driven by the increase in internet traffic, by the emergence of new technologies that Norman and Nicola talked about before, like the cloud, like artificial intelligence, virtual reality, Internet of Things, autonomous driving, and so on, which creates an immense need for data. And as a result, the demand for data center has kept on rising and is expected to continue rising in the future. So an investment in data center really offers, we believe, a compelling way to gain exposure to the technology sector and to generate potentially strong capital appreciation if some of the trends that I just described materialize, while at the same time benefiting from a high cash flow generation and strong downside protection. Why? Because again, here you have long-term lease contracts in place, 10 years plus. You have very sticky tenants that usually invest in the data center themselves more than the landlord. And you have a strong credit quality. Again, these leases being backed by some of the most notable and financially sound technology company in the world. So on the right-hand side, you can see again in brown that data center investment is typically able to generate between 6 to 10% of income yield, which is again higher than what can be achieved in liquid alternatives. So overall, and to conclude, I hope I was able with these different examples to illustrate how private markets, generally speaking, can help generate income in a context of low yield. Now, of course, given the illiquidity, complexity, and risks of such investments, it should only represent a reasonable part of a well-diversified portfolio. But definitely in the current environment, we firmly believe that this asset class presents attractive opportunities that should be looked at.
I would like to thank all the speakers, and I would like to thank for sure all the people attending this webinar, which was I think a very interesting review of our views for 2021. But of course, this is not everything. So UBP is producing a lot of information, is having a lot of recommendations. And you can, of course, look at the Investment Outlook brochure, which is available on our website, and contact us or my colleagues, of course, all the time if you have questions about investments or outlook. And I think we have a great future before us. And so from that side, I would like really to thank all the speakers and you for attending, because it's important to have your feedback as well from that side, and don't hesitate. And we'll see hopefully physically next year and not do the webinar, even though it's a great solution to reach out very quickly to everybody. But in the meantime, stay safe, and thank you to all of you for attending. So don't hesitate to call us as well. Thank you.